I had hundreds, even thousands of financial advisors as clients, and they have a very challenging job, right? And they can be put in a very tough spot. So if a client is unhappy for whatever reason with their portfolio, and that client wants to see the financial advisor doing something, like to fix this, a lot of times the best behavior is going to be doing nothing, right? It's going to be, okay, we're in the drawdown, now we have to live with it. But if the FA says that, the client may walk.
Hey everybody, welcome to this week's Nasdaq Dorsey Wright podcast, episode 2 of the Risk Series. We have a special guest this week, Dr. Rufus Rankin. He works internally within Nasdaq, also just a really interesting person. I got to talk to him a bit yesterday ahead of the podcast, so I'm pretty excited for what he has to say on the topic of risk and just investing broadly, how we think about that. But before we get into it, Rufus, I know this is your first time on the podcast, so for those that are listening, maybe just a bit of background of what you do here at Nasdaq and really how you got to this point.
Sure. So again, Rufus Rankin. I'm part of the Index Research and Development team. I'm the head of Empirical Research, which is kind of fun, quantitative academic type research.
Yeah.
And I work with a lot of fun, interesting, and smart people where we put together indexes and manage them, and also help people understand how to use them. So I've been with the firm about a year and a quarter, year and a half. And before that, I had senior management positions and was a part owner in a couple boutique asset management firms. So I did research. I was the deputy chief investment officer and managed several mutual funds, commodity pools, and other products as a portfolio manager.
That's awesome. That's going to be really good. We were talking yesterday, your path to your current role and some of your PM roles, asset management and finance as a whole was not super conventional because you studied philosophy, correct? And you're
right.
Undergraduate, and then you did a master's degree that was maybe slightly more removed in the international business, and then you did a doctorate study. So kind of walk us through that process and how you came to finance.
Yeah, so ever since I was a kid, I wanted to be either a philosophy professor or an investment manager. And it kind of ended up being a blend of the two. So yeah, in undergrad, I started out as a philosophy major because I thought, it was a good way to approach understanding the world. As a backup, maybe I could get into law school if things didn't work out with the investment side of things. But yeah, I did a lot of work in philosophy, mostly kind of Western type philosophy. And one of the things that really struck me was one of my mentors talked a lot about Aristotle and how, Aristotle wasn't really an ivory tower kind of guy. He was very much involved in the world and kind of like the finer things in life. And Aristotle, talked about Thales of Miletus and how he at one point engaged in speculation. Depending on the different accounts, he either perhaps created the first futures transaction or options transaction based on olive presses. And he did this based on a weather forecast that he had created based on a model he had built. And he did it possibly to prove that philosophy was useful in the real world. So that story really stuck with me. There's several versions, but that's always stuck with me. So I've kind of always considered philosophy to be foundational to any human endeavor you'd want to engage in.
Yeah. It's right. Go ahead.
So yeah, but after you go through the basics like logic, trying to figure out the important elements of the world, both philosophy and quantitative research boil down to kind of one thing, and that's really asking good questions. When I was working on my DBA, my doctorate, my advisor said that doing the research is relatively easy. The hard part is asking a good question. And a big part of that is asking a question that is answerable. So that's a big philosophical undertaking in my book. But yeah,
I totally relate to that. I'm definitely young in the investing world, and I've figured out how to do data work, but it's to your point, like asking the right questions, like what data should you be looking at for us? What models should we be making? Yeah, no, that's a really good point. Given that this is a risk series podcast, I'll kind of pose it to you now. Your experience both in philosophy and in work, active portfolio manager, empirical research, and so forth. What's been your involvement with risk? How would you define risk, et cetera?
yeah. I've had a lot of different interactions with risk. So on the academic side, it's usually relatively narrowly defined, and it kind of has to be. So, in our world, that might be the volatility of a portfolio, for example. I've noticed that people, myself included, tend to worry a lot more about like really low probability or really low likelihood events, and don't worry
Tails,
about
yeah.
things that are very likely to happen. Like I worry a lot more about being in a plane crash, for example, than I do about like heart disease, just as an example. And investors will often think about like big crashes, like bear markets, when maybe a bigger and more pernicious risk is inflation, which until recently has been completely out of the headlines. So people, and I 100% include myself in this, people tend to weigh risk inappropriately based on their probability. So one thing that I think everybody can do is think about kind of probability weighting of different risks rather than just thinking about the things that are most scary. So that's one thing I think everybody can think about. As a PM, you have your own set of risks that are more business related, and they often come from comparisons. That is, your clients and
Yeah.
your competitors kind of comparing your returns and your results and what you wear at conferences and all sorts of interesting things to something else. And as I always tell my graduate students in finance, I don't care what you're investing in or where, but one of your benchmarks, if not the only benchmark, is going to be the S&P 500. So if you're running, say, an alternative investment strategy that focuses on managed futures, very little connection with the S&P 500, but I often found that the funds I was running with those kinds of mandates were still getting compared to the S&P 500, often unfavorably. So when you have
Mm-hmm.
this constant pressure and constant comparison from your clients and your competitors, that can drive behavior that is outside of what is optimal for what you're doing. So that's an example from the PM world. But another one is financial advisors. I had hundreds, even thousands of financial advisors as clients, and they have a very challenging job, right? And they can be put in a very tough spot. So if a client is unhappy for whatever reason with their portfolio, and that client wants to see the financial advisor doing something,
Yeah.
like to fix this, a lot of times the best behavior is going to be doing nothing, right? It's going to be, okay, we're in the drawdown, now we have to live with it. But if the FA says that, the client may walk. So that's a really tough spot. And this is where philosophy seems to be helpful, going back to philosophy, because a lot of the successful FAs I know and had as clients over the years would really kind of work on this angle. When they brought in a client and through the years, as they worked with this client, they'd always go back to, what do we believe about the market? What are we trying to accomplish? What can we do about the market based on our beliefs about them? And what is our plan relative to your goals and your risk tolerance? And so repeating that, going through it, and then when the client is unhappy with short-term performance, walking through that and maybe doing a reassessment are some of the behaviors I've seen successful FAs doing to kind of deal with risk, but also deal with the psychological elements that in the the feelings that their clients are having. So they're not just like, oh, well, we have to stick with it, and then the client says, I'm taking my money elsewhere.
Yeah, there's a lot of really good stuff in there. Last week we had a guy from our firm on named Jay, and we were talking about, we kind of coined it business risk, where you
Mm-hmm.
have a strategy that may work over a 10-15 year period, but people can't hold on for that whole investment horizon. So the risk is interrupting compounding is what we would say, pulling out in inopportune times in down markets, like you said, based off of short-term performance. So it's this pattern of rational people making irrational decisions, which is tough. I mean, maybe people aren't as rational as we think they are. I'm sure you could speak to that with a lot more color. But you said something the other day that I was going to circle back on. You said like the most successful investing is just doing simple things over and over again, which is not snazzy. It can be boring, but in your research and in your time, it seems like that's the best approach. Would you also say that's kind of the lowest risk approach, or what's the tie-in, if any, there about doing simple things over and over?
Sure. Well, where risk comes in is exactly as you put it, which is interrupting compounding. So if I decide during a very nice, pleasant bull market that I'm going to have a particular strategy, there is a big risk that when you go into a bear market, which happens from time to time, you may be at risk of not having that conviction in your strategy or conviction in your plan. And, if you don't have that, you're very likely to make changes, sell at the wrong time, sell bottoms, buy highs, things like that, which is really unfortunate. But it is not, one or two people who have done this through time. All of us are kind of wired to do that, it seems, in a lot of
Mm-hmm.
cases. And so we really have to be kind of like Ulysses or Odysseus and somehow figure out a way to put rules in place that at least reduce the likelihood of making those kinds of behavioral mistakes. And it's really hard. So when I talk about those simple things, I've been very lucky to meet and invest with lots of successful traders over the years. And I feel like investing is the opposite of a good action movie. It should actually be boring. The more boring, the better. And so maybe, it doesn't matter if your edge is, I'm going to use a 60-40 approach. I'm going to use 60% US equities and 40% US bonds and rebalance. If that is your strategy and you're really committed to it, you need to stick with it and not mess around with it. Or if you are a short-term directional trader, it's the same thing. Where people get into trouble is they build an established process. They've done a lot of research that supports that this is going to get them there eventually. And then stress enters the equation and all bets are off and changes get made. And, when I was investing in hedge funds and CTAs, that was often a big flag for us, is when a manager goes into drawdown and then says they fixed the problem by changing a lot of the parameters of the model. That's
Mm-hmm.
a time when you have to say, okay, we really need to dig in here, because this is where a lot of bad things often happen, unfortunately. So we know that markets have both bull and bear cycles. We know that equity markets can draw down 20, 30, or even more percent during these bear markets. The one missing piece is we don't know when. And I think most of us, excuse me, kind of agree that we don't really have the capability to forecast bear markets very well. So, there are things you can do behaviorally, but also as an investor, that I think set you up to have a potentially better ride or a better night's sleep while you're navigating markets like that. And two things we talked about yesterday were momentum, both time series and cross-sectional, and also options, and how these strategies can kind of work together to mitigate, manage, transform risk, and in many cases, create investment return streams that are a better fit for a lot of investors.
we've had a lot of conversations this year in 2021 about momentum and its underperformance. So for those that are just completely green, momentum in a nutshell is you're buying winners and selling losers in a systematic, unemotional way as much as possible. So for us this year, it's been really difficult. Momentum's like the worst performing investment factor and over probably a 3-year period. It might be as well now. 2022 is decent because of energy, but overall, it's been a really rough environment for momentum. So we've been getting requests to change our investment strategies or make something work in the current environment. But to like what you said, that's a big red flag when you don't want to alter your system or alter your process when you're in these prolonged bear markets or periods of abnormality. Tons of recency bias comes into play, and we're trying to avoid that by being unemotional as possible. So that was just a quick tangent that I wanted to throw in. Jay and I talked about that last week. But back to what you were saying at the end about momentum options working together and really playing nicely in portfolios to help mitigate risk from all types of angles. Just broadly speaking, what are some kind of practical ways that we see that take place? Of course, the systematic process, I think, could be one of momentum. What else would you add?
Sure. Well, just going back to the point about having some tough sledding or skiing for momentum recently, these periods are kind of part and parcel of the long-term expected behavior of the factor, right? So I definitely feel your pain. I've been in your shoes for many times over many years. So it is challenging to have those discussions with clients, but have these discussions with clients we must, right? So yeah, it's definitely part of it. There are statistical approaches to figure out, is this time different? Because it always feels like it's different, but you know what? It usually is not any different at all. It's just kind of part of the expected behavior of the factor or the strategy or the approach, right? So mostly just making a statement of empathy there, but I do personally believe momentum is a very effective approach in both directional methods, both time series and cross-sectional. So it will get better, but we just don't know exactly when. But yeah, so momentum, especially from a time series perspective, has the ability to systematically reduce or eliminate or take out exposure to assets that are effectively experiencing bear markets. So medium-term momentum has been demonstrated over not years or decades, but centuries from the time series perspective to do a pretty good job of reducing the risk of a portfolio. That is, using a long flat or a long short approach based purely on absolute, another term for time series and momentum, can really do a good job of reducing the risk is basically by cutting off a lot, not all, but a lot of the bear markets or drawdowns that assets invariably go through. On the cross-sectional side, which is also called relative strength, this approach has the ability to shift capital from assets that are weak, possibly generating negative returns, into assets that are strong or generating positive returns or less weak returns, depending on the way you execute the strategy. So I've always seen momentum, both flavors, as being a strong arrow in the quiver, so to speak, or strong way to approach managing the risk of a long-term investment portfolio. On the other hand, if we say momentum is the yang or the yang, the yin of that could be an approach that uses some options as well. And there are a few different ways that an investor or an FA can use options to either generate different returns or reduce the risk. So one standard approach is a covered call or buy right strategy, which is very helpful in generating income, number one, but also to the extent that you're generating premium, perhaps on a monthly basis, that can also cushion some of the drawdown if the market that you're referencing goes into a drawdown. But also there's other ways to do this. So a protective put strategy is a strategy where you're long an index and then also buy, say, quarterly puts on that index. So you can put a pretty strong floor on the left tail of the returns you'll experience.
Mm-hmm.
And then another one is just to use a collar strategy where you're short a call and long a put, and you can kind of make a little bit of a collar or a channel that the value of your portfolio will move through during the course of that approach. So these are all derivative strategies. They're often a little bit too complicated for a lot of individual investors and even FAs. But one thing that we do in our section of Nasdaq is we do have a suite of strategies that execute an option strategy based on the Nasdaq 100, for example. So that's a way where an investor can hopefully find a product, an investment product that tracks one of these indexes, and then they can have, say, a buy right exposure to the Nasdaq 100 or a protective put or a cover, or excuse me, or a collar approach or a collar exposure on the Nasdaq 100. So that's one way to look at it.
Yeah, that's a really nice transition from the factor into like some embedded risk benefits of using products like that and you using options together. That's great. I want to circle back to you said about momentum kind of underperforming and people trying to ask the question of this time is different. Is it different? As technical analysts or studiers of security prices, individuals dictate security prices, or humans to some sort drive security prices, and human behavior, some would say, is cyclical, and there's really nothing new to human behavior over maybe 50, 100 years or so forth. So would you add any comments on that in terms of human behavior and its relation to security prices, or is that just kind of me coming out of left field, you think?
No, I've heard for years as basically as computers get more involved or do more of the work of investing and trading, there's kind of this, hang the hat of technology on whatever your fear of the year is. So I mean, 10, 15 years ago, I was hearing a lot about high frequency trading and how it's going to destroy markets or make markets make it impossible for investors to generate returns or lower hedge funds to generate returns. You can kind of name it, or dry up all the liquidity in the market. So I often have seen this a lot where there's kind of a theme or a zeitgeist and people say, oh, I'm worried about losing money. Maybe it's going to be because of this. So, at the end of the day, humans are still making the decisions, like you said. So whether it's a high frequency strategy or a slow strategy, a systematic strategy that has more and more increasing elements of automation involved in it, if that strategy is not performing up to the human or the group of humans who put it together standards, or behaviorally, if it makes money for a few years and then starts losing money for a few months, those humans are still going to change it, pull the plug, or engage in all the behaviors that drive the kind of basic currents that happen in the market. As a momentum person, you may have heard of Trends. They're a trend following manager based in Rotterdam, actually. And Harold, their head of research, has been there for decades, once said at a conference that trends are like winds. So if you have a planet with an atmosphere, you're always going to have winds. Now, you may have periods of calm. You may also have hurricanes, but something is that you're going to have trends eventually, once again, because it's just like winds. So I found that pretty interesting because it was a good use of, non-technical language to talk about how trends, currents, these are a feature of markets that are not going to go away. And the reason for that is because at the end of the day, humans are still driving prices and maybe it's a bit more intermediated through computers, but it's still humans who are making the decisions.
That makes sense. That makes a lot of sense. Well, I know we're probably running up to the end of what we had allotted here. Any kind of final thoughts on the idea of risk? Maybe anything you'd want to say to our advisor audience about ways to think about it, ways to mitigate, ways to talk about risk in the investing framework?
Nothing super wise or exciting, but especially for financial advisors, I feel like you have such an important position in the world as stewards of your clients' wealth and hopefully preserving it for future generations. So I hope the tools that we offer at Nasdaq, be it Dorsey Wright, the index team, or others, can be helpful in that journey and helpful in that important role that you play. But yeah, thank you so much.
Yeah, absolutely. I appreciate you being on. Tons of great things shared. Thanks to everybody for listening this week. We'll be back next week with our third episode of the Risk Series podcast.